Sound of Money with Santosh Sirur.
Hello, Mr. Munot, and welcome to the 100th episode of The Sound of Money.
Many congratulations on the century, Santosh. Always a pleasure to interact with you.
Thank you so much, sir. Mr. Munot, my first question is obviously, of course, considering the geopolitical situation, and I mean, the question is all about where do you see the India growth story in terms of its momentum? How can the country Bharat sustain its momentum in the coming years? Where do you see this going?
No, and a large part of the world is dealing with the structural challenges, whether it's aging population, whether it's excessive leverage in many of the developed countries. But India has got many structural factors driving its growth. And over the
Hmm.
next several decades, I think country will continue to grow from strength to strength. We've got a young population, one of the youngest countries in the world. We've got a functional democracy. We've got digital infrastructure, which is absolutely unparalleled. We've got an
Yeah,
economy which is formalizing, and confluence of other factors would ensure that India remains one of the fastest growing major economy in the world. And over the next several years, I think we will have a multi-pronged strategy on the growth. So it is not dependent on semiconductors, not dependent on a particular sector, but I think it's a consumption, it's investments, it's exports, it's import substitution. On variety of these structural factors, India's economy would continue to grow, and I remain very positive as ever. Of course, there are geopolitical challenges. There are some of the other factors which are impacting us in the short run, but we should not lose sight of the long-term picture.
absolutely. Mr. Munot, in terms of mutual fund penetration, India has done a phenomenal job through AMC, through all your AMCs, and of course the financial literacy. Uh, what's that one thing that you think, or one or two things you think that there's a lot more that probably can be done to get the population to invest more?
Our SIP book on a monthly basis has grown to 32,000 crore rupees per month. This number used to be around 3 or 4,000 crores in 2016. So we have come a long way. Number of
Yeah.
investors have been growing, but still we have a lot bigger market to be tapped. There are 3 or 4 factors that have led to this stupendous growth of the industry over the last couple of years. One is a track record. Now industry can go to the investors and showcase a 30-year track record of investment performance despite many cycles. The second is the technology, which is making it easier for us to reach out to larger number of investors, to communicate to them, to do the onboarding, do the KYC, create the portfolio, and manage it. So technology has been a big lever. The third, I would say, transparency. I think along with the regulator and the industry body, all of us have worked very hard to make this product more transparent and more investor friendly. Last but not the least, and just creating an acronym, fourth T is the training. By training, I
Mm.
mean investor education. I think industry has done a phenomenal job, not only with the mutual fund Sahi Hai campaign, which resonates well with the people, but spreading the word about SIP, about disciplined investing, about not getting swayed by the volatility. Together, these things have created a trust among the minds of investor. And
Yeah.
what we need to grow over the next several years is not the assets under management, but keep growing the trust under management.
Absolutely. I love that. Trust under management really makes a huge difference, right? How can India actually, in terms of the balance, fiscal prudence, right? More importantly, with the expenditure growth, pressures that are there on the government, achieve that sustainable growth? Any ideas, any views on that?
Yeah, I mean, you can see over the last decade or so, we have been faced with many global challenges at different points in time, whether there was challenges in 2016 or when we had to deal with the COVID in 2020, the Russia-Ukraine war, which led to a spike in the oil prices, and global inflation and interest rates went up in 2022, or the recent West Asia crisis. But throughout this period, I think we have to give credit to the government to remain fiscally very, very prudent. And
Hmm.
now the government has got a stated objective of bringing down the debt to GDP ratio. Until a few years back, we never heard about, we used to monitor the fiscal deficit on an annual basis, but the government is specifically focusing on bringing down the debt to GDP ratio of the country by the central government is something I think clearly shows the commitment towards a prudent fiscal policy. And I think which augurs well in the long run, because Government of India being the largest borrower, if they borrow more, then they crowd out private private investments. And I think they remaining more disciplined is good for the macro stability, good for interest rates, good for the overall, I would say, financial markets.
Okay. But when you look at any certain macro factors, be it industry, be it any particular themes, from an India growth standpoint, the economic growth more so, what's the kind of can it further leverage its growth? Any views on that?
Because of the current crisis?
Yeah,
No, of course. I mean, the we cannot remain insulated from what's happening outside India. But I think what we need to focus is on our structural strength that we have as an economy. We talked about the demographics. We talked about the democracy that we have, the ease of doing business, improving the quality of living for a large number of people, creating jobs for the younger population. And one of the big opportunity I think over the next several years is what I call addressing 5 C's. 5 C's is number one, crude oil and gas. We import a large part of that. Critical minerals, chemicals and fertilizers, critical components, many of the components where we are hugely dependent on rest of the world, chips
yeah,
and semiconductors, and the capital. I think capital in a way that mutual funds are doing a good job in ensuring that we financialize our savings and channelize them into productive investments. We have lesser vulnerability on rest of the world, but still we need a lot of capital. I think over the next couple of years we need to work very hard that how do we reduce our vulnerability on importing these 5 C's.
absolutely. You have been a true Gandhian and self-sufficiency, and especially when it comes to India looking in the future. Till now, we have always looked at United States or the West in generic, and then we have kind of, if I like say, borrowed their learnings, if I may say so. But India has its own huge cultural learning. It has its own knowledge base. It has its own amazing resources at hand. What are your views on it? Where do you see that Bharat heading ahead?
20th century belonged to United States. Before that, couple of centuries to Europe, particularly UK. I think this century really belongs to Asia, and within that, India is going to play a very, very large role. The center of gravity is shifting from west to east and from north to south, and I think India is going to lead with its rich civilizational wisdom, rich ancient history that we have, the ancient wisdom that we have. I think we are going to teach the world capitalism with conscience. Our ethos of Bahujan Hitai, Bahujan Sukhai, our ethos of the Vasudhaiv Kutumbakam, whole planet is my family. Our ethos of the capitalism with conscience, the stakeholder capitalism is something that the world is going to learn. And I have a very strong belief that despite all the global challenges which are impacting us in the near term, I think a structural basis, India will lead the world to a different kind of, I would say, a model to look up to.
Absolutely. On that very, very positive note, sir, thank you so much for being a part of this 100th episode of The Sound of Money.
Thank you so much, Santosh. Always a pleasure.
Thank you.
Good.
Yep, done.
Uh,
Thank you.
Till
Thank
we
you.